Hey everyone, welcome back to Corporate Decoder. Today we're diving deep into PNC Financial Services Group's latest 10K report. Believe me, this isn't your average snooze. Festive numbers, we're uncovering some real juicy details about how they're managing their money and the risks they're facing. Get ready for some insights that go beyond the headlines. Before we jump in, if you appreciate getting straight insights from these massive corporate documents and understanding what they actually mean, make sure you are subscribed. And hey, we have a Discord community linked in the description below where we break down these filings even further. Come join the conversation. PNC, a giant in the financial world, is like a seasoned player navigating a really complex game. They operate across the whole country, offering everything from basic banking to investment services. This year, 2025, they're reporting a healthy rise in their net income, hitting $7 billion, which is a solid 18% jump from the previous year. That is like their profit getting a nice boost. One of the biggest stories here is their net interest income, which jumped by 7% to $14.4 billion. Think of this as the money they make from the difference between what they earn on loans and what they pay on deposits. So they're making more money on loans and paying less to keep deposits, a win-win for them. Their non-interest income also saw a nice bump, up 8% to $8.7 billion. This includes all sorts of fees and earnings like those from managing investments or credit card services. It shows they're not just relying on the old school banking stuff, but are also pulling in solid income from other areas. All this good news adds up to a 7% increase in total revenue for 2025, reaching $23.1 billion. It's like they've had a really good sales year across the board. Looking at their balance sheet, total assets grew by 2% to a massive $573.6 billion. That's a huge amount of money and resources they control. And where is all that money going? Well, loans are a big part of it. Their total loans increased by 5% to $331.5 billion. Specifically, commercial loans saw a good boost, especially commercial and industrial loans, which increased by 11%. That is a sign they're actively lending to businesses. However, commercial real estate loans saw a 12% drop, which could be linked to the ongoing challenges in that sector. Consumer loans dipped slightly, mainly due to fewer residential real estate loans, even though auto loans grew. Keeping all these loans funded, their total deposits also grew by 3% to $440.9 billion. It is good to see their customers are keeping their money with them, especially the interest-bearing kinds, which have grown quite a bit. Now let's talk about how strong they are financially. Their Common Equity Tier 1 ratio, a key measure of their financial muscle, is at a healthy 10.6%. This ratio is super important because it shows how much high-quality capital they have compared to their risky assets. They're well above the well-capitalized threshold, which is a good sign for stability. When it comes to lending, there is always a risk that borrowers might not pay back. That's why they set aside money for potential credit losses. For 2025, this provision was $779 million. While it is a significant amount, it is actually a little lower than the previous year, which might suggest they're feeling a bit more confident about their borrowers' ability to pay, or at least they're managing those risks well. They also reported an efficiency ratio of 60%. This basically means that for every dollar they earned in revenue, 60 cents went towards running the business. This is a pretty good number, showing they're managing their costs effectively. And how well are they using all those assets? Their return on average assets is 1.24%. This tells us how much profit they made for every dollar of assets they had. It is a steady performance, indicating they're using their massive asset base to generate profits. Let's break down their different business areas. Retail banking, which serves everyday customers and small businesses, saw its net interest income grow, but its non-interest income dropped by 15%. This was largely due to a big gain from a Visa Share Exchange program they had in 2024 that didn't repeat in 2025. So, while they're making more from loans and fees, that one-off event in the past made this year look a bit less spectacular in comparison. They're also investing heavily in opening new branches, which is a bold move in today's digital world. The corporate Thiviamp institutional banking segment is firing on all cylinders. Revenue is up 10%, driven by strong growth in treasury management, capital markets, and advisory services. They're clearly doing well in the business world, making more money from deals and services for larger companies. The asset management group also had a good year, with revenue up 9%. This is thanks to higher equity markets and more money coming in from clients wanting their assets managed. It seems like people are trusting PNC to handle their investments more and more. Now, every company has its risks, and PNC is no exception. They're facing risks from the economy, like inflation and trade policies, which can mess with their customers' ability to repay loans. They're also dealing with a ton of government rules and regulations, which is standard for big banks, but these rules are always changing. And then there is the ever-present risk of cyber attacks. In today's digital world, keeping customer data safe is like guarding a vault, and any breach could be a PR nightmare. They say they haven't had any major incidents so far, but the threat is always there. Then there is the risk of a general economic downturn. If people start losing jobs or businesses take a hit, it directly impacts PNC's bottom line through loan defaults and lower demand for services. They are especially focused on the commercial real estate sector, particularly office spaces, due to structural shifts in demand. They expect continued stress there, with a significant portion of loans maturing in the next year, needing careful management. The way they calculate their allowance for credit losses, the money they set aside for bad loans is based on forecasts. And forecasts are tricky. They use different economic scenarios from good to really bad and assign probabilities to them. If things take a turn for the worse economically, their allowance for losses could jump up, hitting their profits. Looking ahead, they just picked up First Bank Holding Company. This is a pretty big deal, adding billions in assets, loans, and deposits. It is a sign PNC is still looking to grow. Overall, PNC seems to be navigating a complex financial landscape pretty well in 2025. Their profits are up, they're growing their core businesses, and they're managing their risks. Though not without some clear areas of focus like the office real estate market, the acquisition of First Bank shows a commitment to growth, but like any big bank purchase, integrating it smoothly will be key. They're staying ahead of regulatory changes and focusing on customer relationships, which are crucial in this competitive market. The main challenges will be managing economic uncertainty, navigating ongoing regulatory shifts, and keeping those cyber defenses strong. Alright, that is our breakdown of PNC's latest filing. What is your take on these numbers and what they signal for the company's future? Do you think their investments in new branches make sense? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives into corporate finance. Don't forget to check out the Discord in the description to keep the conversation going. Thanks for watching. See you next time.